Good evening and welcome everyone. My name is Cameron May and I want to welcome you to this evening's webcast where we are focusing our attention on price patterns, looking at charts and studying history to see if there is some lesson to be learned from historical behaviors of shareholders of different securities, maybe even of an index itself. So let me say hello to all of you returning veterans, whether you're joining on YouTube or you're checking in as Karen Cake is doing there on Thinkorswim, and all the rest of you Thinkorswim that are joining us there on that platform. Welcome back. I consider this to be a privilege to be addressing you tonight. And as a heads up, I'm not standing in for Scott Thompson tonight. I'm actually assuming full-time responsibility for this webcast. So every Wednesday, I'm going to be dedicating 1 hour to an ongoing series of discussions, and we're going to rotate through a number of topics. Tonight's topic, though, price patterns. So plan for about 45-50 minutes for today's discussion. We'll set a more precise agenda in just a moment, but as we always do, we have to first pause to consider the risks associated with our investing. Options are not suitable for all investors as a special risk. Inherent options trading may expose investors to potentially rapid and substantial losses. Spread straddles and other multi-leg option strategies can entail substantial transaction costs. Any investment decision you make in your self-directed account is solely your responsibility. Past performance of any security or strategy does not guarantee future results or success. Probability analysis results shown are theoretical in nature, not a guarantee of what you may expect to encounter as you place your trades. We are going to be using real examples in today's discussion. Do not take that as a recommendation or endorsement of those securities or the strategies discussed, and the usage of a stop order is not a guarantee that you will buy or sell at a specific price. Finally, there is a quick overview of your Greeks. Take a look at those for you options traders. That can play potentially an important part in the administration of your options portfolios. But let's get right to it. Hey there, yeah, it looks like we have confirmation. Some are joining for the very first time on Thinkorswim, so looks like we might be, well, we made a connection there. And I do appreciate those who are following on Thinkorswim, the veterans who are helping out those who are here for the first time with the navigation there. Hello there, Alfred. Good to see you. Good evening to you. But let's get right to it. Let's set an agenda for today's discussion. Let's bring up the Thinkorswim platform. I just have three things that we want to cover today. First of all, we're going to be doing an introduction to price patterns. I'm not going to spend too much time on this because this is more of an intermediate level discussion. I will give an invitation if you are brand new to technical analysis or chart analysis. I actually teach a class every Monday, and I'd like you to join me there. It's Monday, 11 o'clock Eastern Standard Times in the morning, and we spend half an hour just getting acquainted with the initial principles of technical analysis, setting up your chart, trend identification, support and resistance, and yes, even price patterns. So I'd love to have you there. But for tonight, we're still going to take a few moments to define what price patterns are and how conceptually they might be used by a chart enthusiast or a chart trader or investor. Then we're going to get into the specific price pattern types, and there are two broad categories of price patterns: continuation patterns and reversal patterns. I'll explain those in more detail as we proceed. And finally, we're going to illustrate these concepts and apply them in current market scenarios using example trades. All right? Once again, the examples that we use are for informational, educational, illustrative purposes only, but I think it'll help to cement these concepts. And as we go, I always give an invitation. If I leave a gap in your understanding of something, ask a question. I'm keeping an eye on the chats. Make sure that we cover those questions. As long as they're on topic and they're educational in nature, love to have them. All right? So let's get to it. What in the world are price patterns? Well, broadly speaking, price patterns are just observing how shareholders of publicly traded companies have behaved in the past in an effort to see if that might provide some insight into what might happen in the future. right? Obviously, there's no guarantee of what the future holds. But if traders have behaved in one way in the past, is it at least conceptually plausible that they might behave in that way again? Yeah, that's the theory there behind a price pattern study. And so there has been a group of these sorts of behaviors that appear to repeat themselves over time. And I'm seeing a couple more questions coming in through Thinkorswim. Just confirm for me, you Thinkorswim attendees, looks like there might be an issue with sound, something like that. If you need to pop over, I appreciate that. TDA Sean recommending maybe if you are struggling with sound, I'm aware that there have been a couple of technical hiccups on Thinkorswim. You might need to pop over to the YouTube stream. All right? But yeah, that's the advantage of having things simulcast. We have a built-in backup already going. All right, but and just to check one more thing, Alfred Thomas, do me a favor there. Let me know that sound and video is coming through loud and clear for you. You should be looking at a chart of O'Reilly and our agenda for the day. Okay? But make, if you could, specific reference to sound and to the stream. Anyway, looks absolutely fine from my end, so I'm going to proceed. So why, we've talked broadly about why an investor might be intrigued or interested in, and thank you, Thomas, perfect. Donald, excellent. Okay, so yep, with apologies, I don't know what the issue might be there with the Thinkorswim broadcast. They can join us over here on YouTube. All right, but let's go through some potential applications for price patterns. Okay? Number one, a price pattern, when you see behaviors repeating themselves historically, and maybe I'm going to start things off with one of the most common price patterns. I'm going to sort of launch ahead to what we call a bull flag. Let me bring up BDX, symbol BDX, that's Becton Dickinson and Company. And what we're going to look at here, I'm going to zoom in, and you'll notice, and this is something you'll see on a lot of charts, stocks will tend to move in one direction, then pull back against that move, and then move in the same direction and pull back against that move. And we have a name for that. That's called a flag pattern. So we're going to use a flag pattern as our stand-in for all patterns, generically speaking. The first thing that a pattern might offer to an investor is, or to a potential trader, is an identification of support and resistance. With a flag, we see a stock running up. Let's draw this in. Here's a recent flag. We ran up to a peak, and we've pulled back to a low. When that flag pattern resumes upward, that may identify for us a support level. It can potentially also provide for us a resistance level. But one common thread that you'll see running through price patterns is that they all consist to some degree or another of support and resistance. Okay, how is that useful? Well, it may provide us with the next step. Let's outline these for you. Support and resistance, one potential application. Support and resistance identification. There we go. That leads us to our next potential application, which is an entry signal, a technical entry signal. And this could be true for a bullish pattern or for a bearish pattern, a bullish entry or a bearish entry. Price patterns can also potentially offer exit signals. And this is if the trade is performing well, meaning we're hitting a target, or a stop. So exit signals if the trade is doing well or doing poorly. All right, now anytime I mention the word stop, I've got to mention that the usage of a stop order is not a guarantee that you'll get a sale at a specific price, or in the case of a bearish stop or a buy stop. It's not a guarantee that you'll buy at a specific price. All right, fourth potential application for a price pattern is a time frame of the trade. If you've ever struggled with, well, I wonder how long this move might take. If I'm expecting, let's say, a stock to move from $45 to $50, how long might it take to get there? Price patterns may provide some potential insight into that. And finally, direction, bullish or bearish. Okay, the price patterns can be applied in either direction. So again, a broad discussion of how price patterns might be used. So let's start to frame that, and let's discuss the two different potential types of patterns. We have consolidation. Actually, pardon me, let me back that up. Continuation and reversal patterns. Okay? So what I want to do today, let's make sure that we cover at least 2 continuation patterns and at least 2 reversal patterns and see how they might provide these 5 potential applications. Okay? Continuation example number 1, flags or pennants. All right, so turning our attention to Becton Dickinson here. Here is a price pattern. I'm starting with this because it's probably the one that you're going to encounter most frequently, because it's one of the I wouldn't call it an essential building block of an upward trend, but it is a common building block of an upward trend. It's also a common building block of a downward trend, this flag behavior. All right? And even this little example of BDX contains within it 2 potential examples of a flag. So a flag consists of 2 segments. Number 1, this price pattern has what we call the flag pole, and you can see why we call it the flag pole. It kind of looks like if you imagine the flag that's hanging off your front porch, hanging out there at a bit of an angle, but generally pretty straight. Yeah, it consists of an advance in the case of a bullish flag. There's our flag pole. And then the flag itself, where the stock price pulls back against that upward move, or sometimes it'll actually float a little bit sideways. Okay, let me come up here and I'm going to clear up this drawing, and I want to show you that we have 2 examples of that flag pattern right there. So we have a flag pole, and then we have the flag itself. So that's the identification of a flag pattern. Why does it seem to have some application? Why does it happen? I think that's what we want to examine right now. Put yourself in the shoes of shareholders who owned shares of BDX way back here. So looking back to early January, the stock gets ahead of steam and it runs up from a low down here around 210 to a high just about a week later. It hits a peak of about 230. That's a $20 move on a $210 stock. That's close to 10% in a week. So here's my question for you. If you had just made 10% in a week, and that's about what an average investor might expect to make on a portfolio over the course of an average year, right? So about a year's worth of production in a week. Might that cause some investors to think, well, wait a second, maybe it's time to take some profits off the table, right? Conceptually, that may be happening. It's never a guarantee. It's not going to happen every time. But as prices push higher, there may be a tendency to start taking profits. And so that might lead to prices sagging a bit, despite whatever the good news was that got the upward move started in the first place. So if you look at that, if you're looking at the inherent psychology in a move like this, you might expect, okay, so once that profit taking is done, maybe the stock will remove the upward, resume the upward trend, and maybe we might get a repeat performance. That's kind of the genesis of this sort of a price pattern. A big swing up. That big swing attracts the eyeballs of other investors who didn't own the stock to participate in the upswing, but maybe they're waiting for their opportunity and their hope that it might repeat itself. So what they might do with a flag is look to see, where did this thing start and where did it end? Where was the support? Where's the resistance, right? Because that distance may be an indication of how far it might move again. And look at what BDX did. It went up $20 and then it drifted for a little while. Conceptually, maybe some profits being taken. How far did it run again? I haven't done the math on this, but let's see. So it bottomed out around 226 and then ran up to where? About 242. Just a little bit shy of $20, but pretty close to a repeat performance, right? Once again, maybe shareholders are thinking, maybe let's take some profits. But that's what we call a flag pattern. And it can be the introduction for a lot of investors to this concept of pattern identification. All right, so let's move on down the list here. What would be an entry signal for a flag pattern? Well, if we're waiting for the stock to bleed off a little bit of profit taking to happen, how long do we wait? Well, one common measuring device is to look at how long the stock went up and then look for maybe a retracement somewhere around the 1/3 to 1/2 of that time frame. So if this took 5 days on the way up, maybe it pulls back for 2 or maybe 3 days. And that might help us potentially with the timing. And then specifically, we might look for the stock to resume the upward trend. And one way that we might do that is if I'm going to leave that in there, but if you'll notice this downward sloping area of resistance where I drew across the top of what we call the flag right there, breaking through that might be an entry signal. It might mean, all right, so the profit taking is over, the upward move is resuming, and that could be an entry signal. Where might be an exit signal then? We've already talked about one of the exit signals. This trade is ultimately going to do one of two things. I suppose it could decide to go sideways forever. Conceptually, I suppose that's within the realm of possibility. It's not terribly likely. But it's either going to go up or it's going to go down, right? So a technical trader might have a plan for either one of those scenarios. If the stock goes up as anticipated, how far might it go up? Well, that's what we call a target, and that's where we use the length of the flagpole. And you might look for something on the order of $20 or so once we've broken out to the upside of this flag pattern. Now it's not necessarily $20 from the breakout point, but $20 from the start. That would be down here at the bottom of the flagpole. Okay? So that might give you a target. It might be a little bit above where it's already gone. What if it doesn't pan out? A technical trader may have a plan for that as well. And with price patterns, if the pattern itself fails, that might be a reason to exit a trade. So put yourself in a trader's shoes back here that's using a price pattern breakout. Had the stock not continued up and instead it started to collapse, if it gets back down below the lowest point of this portion of the flag, that may be a signal that this one just isn't going to work out. And so a technical trader might have an exit down here, some degree or to some extent below the lowest point of that flag. So we're starting to build, and by the way, you can position this, it might be a percentage point or two, it might be a dollar or two. That's up to the trader. And whether you choose to use this as a stop or not is up to you. Once again, if you do choose to use a stop, at least you're drawing a line in the sand, even though it's not a guarantee that you will sell at exactly that price, right? But it allows you to create an entry signal, an exit signal, and also does potentially provide a time frame. If the stock took 5 days on this upswing, how long might we be expecting the move here? Somewhere on the order of 5 days. Right now, it's starting to show some technical signs that it might have already peaked. It may wind up coming up a little bit short of a $20 target, and it may come up short a day or so short of a 5-day time frame. But at least we're getting a general feel, right? And then finally, the direction. Price patterns are generally grouped into either bullish or bearish. What defines something as a bullish or bearish pattern? Well, for each one, you determine the trend in advance. So let's zoom back out again. Actually, right here will do. That was actually good enough because we had an apparent trend established. What was the trend leading up to this most recent price pattern? Well, we had a low back here. We had a high right here. We sagged down to a low right here. That gave us a higher low. And as we pushed up from there, we broke to a higher high. So we had an upward trend. And this is, so I think a technician can make a technical case that we have an upward trend, and therefore we might be looking for bullish patterns. And this is a bullish continuation pattern, which means that it's forecasting, that's not a guarantee, but the outlook would be that this trend would resume once the pattern completes. So, taking the discussion that we just had, would you say that Becton Dickinson is giving a buy signal yet? It ran up for 4 days. It's now come down for 2. The time frame seems to be lining up, but we're still below that downward sloping area of resistance. Okay? If we break to the upside, that may be an entry signal. Okay, Amer just asked a question, and thank you, Trader Talks from TD. Appreciate that. Amer says, if you use the ATR as a stop, what do you suggest the multiple of the ATR? So what Amer is asking here is that something's called an average true range. That sounds fancy. All that means is how much does the stock move in a typical day over the last 14 days or so, okay? You'll notice today it moved from a peak up here down to there. That's a range of $4.89. What's been the average range over the last 14 days? And why would they ask that? Why would someone ask that question? Well, the idea there is, I'm going to use an exaggerated example here. Let's suppose that we just bought shares of BDX and we put a stop 2 cents below the current price. Well, you have a stock that seems to be moving around. Boy, you know, today's candle looks like it's about the right size for the last 14 days or so. So it's kind of around its average trading range. We might say it has an average, and you can actually bring up a technical indicator here for ATR. I'm not going to do it so I don't get too far off track, but I don't mind taking, you know, a question like this because I think it's pertinent to the discussion because it's addressing the concept of stop placement. Okay. If we have a stock that's let's say it's moving around on average about $4.50, and we put a stop 2 cents below our entry price, what is the mathematical, highly probable outcome of that trade? You're probably going to get stopped out, right? It's not, you know, maybe you happen to catch the absolute bottom of current prices and it moves up exactly from there. But if your stop is too tight, it might lead to a whole lot of orders trades getting kicked out very quickly. So a trader might look at something like the ATR to get a gauge for how much wiggle room they need to have a stock. So if a stock is moving $4.50 in a day, maybe they go at least $4.50 below their entry price, or maybe multiples of that, maybe $9, maybe $13.50. So what Amer has said here is, do we take ATR and multiply it by 1.5 or 2? Amer, it's a good question. If you're using ATR for your stop placement, if you're using stop placement at all, it's not one that I can really give you an answer to. It's going to be up to the trader, because if you use a tighter stop, well, great. Maybe if you do get filled at your stop, you've limited your downside loss, but you've increased the likelihood of getting stopped out, right? Because it's tighter. If you use a looser stop multiplied by a higher number of ATRs, well, conceptually, that reduces the risk of an early sale on the order, but if you do get stopped out, it's a larger loss. So there are pros and cons to either one. There's not a right or wrong answer, right? Okay, good. Very good question. Yeah, all right, so there's our first potential price pattern. Started with it because it's maybe the most common. I also lumped in here pennants. What is a pennant? Well, it's a flag, has a flagpole. It just, the pullback, instead of getting lower highs and lower lows during that flag portion, instead we get lower highs and higher lows. Now, I don't have a current example of a pennant, but let me just clean off all of these drawings. And let's say, just for sake of argument, we got this flagpole right here, and then we got lower highs, but the lows got higher, and you wind up with something that's more triangular. Okay, that's what we call a pennant, and I think you can see why it's called a pennant. For obvious reasons, it kind of resembles an old-fashioned, at the old sporting events, football games, you used to see people holding little tiny flags on a dowel, on a stick, basically, that were triangular. It's called a pennant. Yep, that's called a pennant. Whether you see a pennant or a flag, though, the interpretation is essentially the same. If the flagpole develops in an upward trend, and then you get the flag or the pennant, we look for a bullish breakout and use the flagpole length to measure length and the time frame to measure the time. If it's bearish, you just reverse that logic. Okay, so that's a flag or a pennant. What's another continuation pattern? Very common continuation patterns. Let's get geometric, all right? Common continuation patterns, we have rectangles and triangles. With each of these continuation patterns, a common theme among them is a consolidation or a slight retracement. So with a flag, we have a run-up and then a consolidation or a retracement. A run-up and then a consolidation or a retracement. With a rectangle or a triangle, it really is a consolidation. It's where prices go sideways for some time. So let's look at an example of a stock that was going up. Look at O'Reilly Automotive. It was running up, and then what did it do? What has it done for months? Wow. Let me get my, I'm going to change my tools right down here. I've selected my channel tool. But here we have the stock that ran up, and then it just started to consolidate. In other words, it went sideways. And if you look at, I'm just going to draw two lines, resistance and support. There we go. Support and resistance identification is one of the things that price patterns might help with. Notice I didn't capture every single moment of trading, but over the last 6 months or so, last 5 months, we've captured probably, I don't know, 95%. I don't know the exact number here. Boy, the stock seems to be stuck between about 325 and about 357. Now, as you look at that, when you have a stock that's come up quite a ways, and then it started to go sideways, what might our instincts be? Oh, this must be the beginning of the end for the stock, right? Must be a top. Well, a consolidation in an upward trending stock is actually commonly seen as just a resting period. At least that's the technical assumption here. This one's dragging out maybe a little bit longer than you see normally. There are some that'll go longer still. But once we've identified this consolidation, we call this a rectangle. And we call that, I think it's fairly obvious, but let me go ahead and draw a rectangle in here. There we go, just to help you visualize. So how might this be useful? Well, if the assumption is that we're just taking a rest, once the trend resumes, we might look for an entry signal, a breakout to the upside. Oh, Scott's asking about other potential patterns. Yeah, Scott, so there are definitely going to be some where we just don't have time to get to them. You're mentioning one of these. Yeah. Wedges can be a consolidation. Yep. Or you're saying right here, maybe you have a wedge. Yeah. All right, yeah, I don't want to go too far into that, but I think you could make that case, Scott. Very good. But with this pattern, just with the bull, just like with the bull flag, when you have a continuation pattern, you might look for a breakout of resistance as your entry signal. Conceptually, if you're patient, you might also look for just a bounce off support, maybe something down around this level, if you're willing to wait out the fact that we're still below an apparent price ceiling. Because the technical assumption here is we should, it's not guaranteed, but the assumption is we might break out to the upside and continue that trend. Okay, what would be an exit signal here? Well, a target, just like with our flag, might be established using the depth of the pattern. Now here we're not going to use the trend that was leading up to the pattern. Instead, we use the depth of the pattern itself. So if we have a stock that's moving in a range between 325 and let's say 355, just to round it off, there's a $30 range. Once it breaks out to the upside, what may happen again? Well, if the assumption is that, well, we were in a $30 range, maybe we just establish a new range at a higher level. A breakout at 355 might provide us with a target around 385, just off the top of this chart. What if we're wrong? What if we got that breakout and then it failed? Well, a trader may have an exit plan to get out. Let's say we got in up here with the assumption that we're going to move up to our target. If it doesn't, maybe we have a sell order down inside the channel again. So you're noticing some common threads running through support and resistance, entry signals, exit signals including targets and stops, direction, and time frame. With this one, how might we estimate the time frame? Well, if we see this rising and falling between two levels, and let's say it's taking a week and a half to get up, maybe a week or two to get back down, well, maybe we look for a target of $30, an advance of $30 over the course of the next week and a half or two. Okay? So those are some examples of continuation patterns. A triangle is very similar to a rectangle, except it's when instead of having relatively similar highs, relatively similar lows, instead we're seeing, and maybe there's an example here. Let's just clear the whole drawing set. You notice there was a time here where the highs were getting lower, but the lows are getting higher. Someone looking at things on a shorter term time frame might see this as a triangle. Now, even though this is triangular in shape, and I use this as an example, is this a very good example of when a triangle might be useful? There's one thing that a technical trader might look at and take some, well, they might disagree with this as being an example of a triangle. Here's the potential problem. This is a continuation pattern. Continuing what? Well, by the time that pattern developed, where were we headed? Sideways. A triangle at the top of an up move, okay, that might be considered to be a little bit more traditional, more of a textbook triangle than a triangle that happens after the stock's already been going sideways for a while. All right, let me clear off that drawing set. And let's move on to, yeah, Scott, you got it. Scott, typing away, I realize there's a delay between when I ask the question and your answer gets to me. Nailed it, Scott. Exactly. Okay, so what about some reversal examples? I think that it's a very common thought when a stock has been going in a direction for some time. Hey, is this the top of an uptrend? Is this the bottom of a downtrend? And technically, some chart traders have attempted to apply some analysis in an effort to address that question. So reversal patterns. Not going to cover them all, but let's cover some of the more common ones. Okay, reversal patterns. We have double or triple tops, and this also applies to bottoms. And we have head and shoulders patterns. And you can also see examples that are inverse or inverted head and shoulders patterns. So let's look at an example maybe of how about we start with a double bottom. We've been talking about upward trends for a while. Let's give you a balanced education. Let's look at a downward trend. Here is Illinois Toolworks. If you look at this, I can just quickly draw in a trend. Let's draw it to right about here, okay? But the stock generally making its way down from January of last year right up to October. And you can see the low getting lower, the highs getting lower, and then we hit a low right here, okay? At that time, in late October, you might say, well, we're still in a downward trend. Well, then we get a rally up to a peak right there around 141, and then we sell off and look at this next low. It's not identical. We're not looking necessarily for identical lows, but similar lows. What might be going on with this trend? Well, it doesn't appear to be making further progress downward. Sold off down to a low and then rallied. We've sold off down to a similar low and we've rallied. This may be an emerging example of what we call a double bottom. Now, some of you might know this as a W pattern, right? Because it kind of looks like a W pattern. Let me draw the W in here so you can visualize it. Okay? There we go. What's the confirmation that a technical trader might need to confirm, oh yes, so this more closely fits the textbook definition of a double bottom, and we have a trend reversal underway. We have what appears to be a trend reversal underway. Well, if we break above this center point, so if you see your two lows, you look for the highest price between them. Might be a little bit over here, might be a little over there, but in this case it's kind of centered right in the middle. If we break above that, here's the situation. We now have equal lows or similar lows, but a new high. If price were to go up from here, we have a higher high to go with similar or equal lows. Now we might have a technical upward bias. Once that's established, how might we determine our target? Well, look at the depth of the pattern again. Looks like we're right around 120 at those lows and right around 140 at that high. So if we were to get a break above this high, that might be our entry signal with a target up around 160. That's kind of interesting because that coincides with the high right back here. All right, so I think you're starting to get the rhythm of how these price patterns work. We have a double bottom. Conceptually, you can imagine what a triple bottom might look like. It would just be if you can kind of see right here where it doesn't seem to be pushing above this high just yet. If it were to pull back down, touch around those same levels, and start to rise again, we get what we call a triple bottom, especially if we finally get that break above the highest point between the first bottom and the last bottom. So what might this look like if you were to flip it on its head? Here's a potential example of that. Let's look at a triple top. I think Applied Materials, was it? No, it was American Tower. American Tower, we hit a peak right here after a run up. It's even kind of a bull flag. Notice that? Run up, pull back, run up again. But we hit a peak right around the 167.5 mark. We pushed a little bit higher, but really looks like we've established kind of a resistance level right there. One touch, a second touch, we pulled back, and now attempting a third rally. If this were to fail at that level and pull back down, we could be looking at a triple top. And conceptually, psychologically, what may be happening here is that investors, they might be looking back at recent history and saying, wow, last time we were around 167.5, it got painful. The time before that, we were around 67.5, it also still hurt. So if we're there again, do you think anybody might be thinking that? It's possible, right? That's a triple top, can be a reversal pattern. With both of these, it starts with support identification or resistance identification, right? Support for a triple bottom, resistance for a double or a triple top. Now, finally, let's look at this. I have this labeled 3. It's actually 2. There we go. Let's talk about a head and shoulders pattern. Another potential trend reversal pattern. And this one, I think, conceptually, it's a very logical pattern for trend reversal because it's literally a trend reversal. Let me show you. Let's look at AutoZone. Okay. Here's AutoZone making its way up. Stock is behaving bullishly from back here in April all the way up to a peak right there, right? Wait a second. Let me have a look at this. Oh, yeah. Okay. But let's look at the individual, these stair-stepping moves that the stock is making on its way up. It's easy to just draw that line, but let me break it down a little bit more. So as it's making its way up, here we run up to a peak right here. We pull back to a low. We run up to a higher peak, pull back to a higher low. All's good so far. New higher peak. So according to what's called the Dow theory of trends, where you have higher highs and higher lows defining the trend, everything's good so far. Higher highs, higher lows. But then we pull back down from that peak, and look what just happened. A very similar low right there. A trend analyst, a technical analyst might look at that and say, wow, this trend, maybe there's something shifting here. We have similar lows. Well, let's see if the high at least goes higher. Well, we get a run up, and the stock kind of peters out in a similar territory to where it did on the on this first peak right here. Let me get rid of these. I'm going to remove that drawing. And let's remove that one. So our focus is just really on these 3 peaks now, because this is our head and shoulders pattern. So we've run up to a higher peak and then pulled down to a similar low. We run up now and we have kind of a similar high to what we had back here. Then we pulled back down and we came down around this low. If you can imagine why this is called a head and shoulders pattern, it's because, well, if we rounded this off, it might look like the outline of a shoulder here, a head here, and a shoulder there. But the concept is that the trend appears to be changing. Had the price broken down further, what would we have at that point? Well, we'd have a lower high combined with a lower low, and we'd have a trend reversal. For convenience sake, some technicians just label that a head and shoulders pattern. In this case, it's not yet a failed head and shoulders pattern. It's just gone on to form another shoulder. That actually is not considered to be a failure of the pattern. It's just an extension of the pattern. This is just sort of a combination shoulder. But what a technician may be looking for is that break of what we call, let me extend this to the right, that's what we call our neckline. If the neckline is broken, we have our lower low to go with our already faltering lower highs, and we have that downtrend. Now, okay, Francisco says lots of distribution on AZO maybe. Yeah, possibly. Distribution meaning selling, right? All right, one more example, because this same concept might be applied to a reversal from a downtrend into an uptrend. Let's look at an inverse or inverted Head and Shoulders. I think I saw one on Home Depot. Let's see. Yeah. All right, so look at what we're seeing here. Lower highs, lower lows. We hit a peak, we hit a low right here. Pull down to a low. Rally to a peak. Lower low. Everything's fine for the bears at this point. But then we rally up to a similar, not exactly equal, but a similar high. So now we're establishing a neckline, and we have the other shoulder. It's working on the other shoulder. Only time will tell if this pattern plays out, but I think you can see how that's just the mirror image. And again, the concept here is if we break that neckline, we establish a higher high to go with what seems to be already a higher low, and we have an uptrend. Final application for these patterns, just like we saw on the others, you can use the depth of the pattern or the height of the pattern in the case of a Head and Shoulders reversal to measure a potential next move. Now, we don't have a pattern breakout. So Farida says, is this the same as a cup and handle? Interestingly, it does share some characteristics with a cup and handle. Cup and handle by some technicians is considered to be a continuation pattern, so not exactly the same. Obviously, like I mentioned, I can't go through all the patterns tonight, but appreciate the question. Yes, it is similar, not exactly the same though. Okay? But let's just assume that we had our breakout on Home Depot. What might be a target? Well, if we have a depth of the pattern going from 158 up to around, boy, it looks like around 180. I'm going to round that to 180. That's about a $22 move. And maybe in our new trend, we might look for a target around $22. That would take us up to 202. Now look at that. Takes us right across these peaks. Right? So there might be our target just to return to that resistance level. If the pattern were to fail, where might we get out? Well, we might have a sell order down below these lows, maybe down around 170. So what would that look like in an order? Let's go put it in an order. Let's go place a trade in our account. Bring up Home Depot. I'm going to right click on the ask price. And I'm going to put it in an order type that not everybody's familiar with. I'm going to put in a custom buy order. It's a buy order with 2 sell orders attached. I'm going to buy the stock right now with a plan to sell if the stock raises to 202 or if it falls to what did we say, 170? Let's put that order in. Buy custom with OCO bracket. An OCO bracket is a buy order and 2 sell orders. OCO stands for one cancels the other. If one of our sell orders fills, it cancels the other one. So for Home Depot, $176 stock. What if we just wanted to buy, what if we want to invest maybe $5,000? That would be on the order of 35, 40 shares. Let's change our buy order to 35. Change our 2 sell orders to 35. Now you can do that automatically by clicking on this little broken chain link that links these all together, so a change that you make here is mirrored down here. But for today's example, let's put in a market order. We don't know what the market price is going to be at tomorrow's open, so I'll just submit this as a market order. And then we're going to enter a limit order. When you enter a limit order, that means sell at this price or higher or better. Let's put that at 202, and we'll make that a good till cancel order. And then our stop, we're going to put that at 170, which means if the price were to fall to or below 170, it would fire off a market order, and then we might be looking at a fill of whatever the market price might be at the time that our order gets to the front of the line. So it's not a guarantee that we'll sell at exactly 170, but we're just looking for somewhere in that range. Okay, we'll change that to good till canceled, and that is an execution of the plan that we just conceptualized here on our chart. All right, there we go. All right, let's do it. Let me just double check something here. You know, actually, this is an account. I'm not going to submit this trade. At least I got to show you how to build this. I'm actually using another presenter's account, so I don't want to tread on their toes. But we've seen how the analysis might be performed, how the pattern might be implemented, and even how the order might be executed. All right, there we go. All right, class, well, we've accomplished everything that we set out to do. I realize there was quite a bit of heavy lifting when we tried to go through 4 different patterns, and really we wound up going through about 8 different patterns in one discussion. That's a lot. But if you'd like to revisit the foundational concepts of technical analysis, go at a bit of a slower pace. That's what I do every Monday, getting started with technical analysis. I'd love to have you in class. That starts at 11 o'clock Eastern Standard Time, and it's just a half-hour commitment. All right? But we've gone through a definition of price patterns. We've discussed the 2 types, continuation and reversals, and we've looked at a number of current examples to help you relate to these new concepts, I think, a little more clearly. So my hope is that having gone through that process, you have another potential tool in your technical analysis tool set if price patterns is something you intend to use in your trading. Hopefully you have a greater level of comfort with that. Let me see this question from Scott. So if it takes 3 months for a head and shoulders to form and break the neckline, would we target 3 months of time for it to reach its price target? Perfect question. Right in keeping with the class discussion, Scott. Yeah, so here's what Scott is saying, going back to our charts. Actually, our last example is a little bit better, right? Let's go back to that AutoZone example, okay? Where it seems to be taking a while. If we finally break down through that neckline, and let's say that our target is to move from, this is going from 900 down to about, almost 800. Wow, that's a big move down, right? 80 to 100 points. Let's say it took 3 months for us to finally break down out of that neckline. Would we project 3 months to get down that 80 to 100 point move downward? Not necessarily. You may still just look at the time that it took to make the initial move right here, Scott. Although, I'll tell you, if it's taking that long, let me help you conceptualize that. So we're just going back and forth like this, right? At that point, when we finally get that breakdown, are we even looking at a head and shoulders anymore? Or are we maybe looking at a rectangle? Yeah, at that point we might be looking at something like a rectangle, and then we might just be looking at the depth of the rectangle for a guide. All right, very good, great question. Everybody, thanks for giving me your time tonight. I'm putting it in my calendar. I'm going to be here every Wednesday. You're invited to join me. I'm going to be setting you loose today, but with a quick reminder of the risks associated with your investing and a little heads up for what's coming up tomorrow. I'll tell you what that is in just a moment. John McNichol is going to be presenting to you on futures trading, but with a little bit of a different approach than some of the other classes. But as a reminder of those risks, we did use real examples in today's discussion. Don't take that as a recommendation or endorsement of those securities or those strategies. As I've reminded you a couple of times, usage of a stop order is not a guarantee that you'll buy or sell at a specific price. But John is going to be talking about technical trading with futures. All right? You know that John does a great job. If you have an interest in futures trading, his class starts promptly tomorrow morning 9:30 Eastern Standard Time. Love to have you there, but whether you join John tomorrow or you just go back and join me next week, I'm looking forward to seeing you then. Next time, we're going to be talking about bullish bounce and bullish breakout entry signals. All right? So getting a little bit more granular with that topic. We brushed on it today. Next time, going to get a little bit more precise. So I'd love to see you there. If you need a little bit of practice with this, if you need a next step, what do you work on between now and next Friday? Well, maybe you bring up some charts, take your understanding of price patterns, and get some practice with it. 2 or 3 stocks, see if you can look over the history and see if you can find some continuation patterns and some reversal patterns. All right, everybody, thanks for giving me your time tonight. I will see you next week, and between now and then, I want to wish you the best of luck. Happy investing. Bye-bye.